Thank you, George, for inviting me tonight. It's a real honor and a privilege to talk to this particular group. George, I think, has the distinction of creating the first value investing program with Prem Watts' support in Canada, and I think it's really valuable. And as an Ivey alumni, I'm particularly honored to be here tonight. I graduated in 1987, which was 25 years ago, and it seems like a blink of an eye, but here we are 25 years later. And I remember sitting in your seats wondering what I would be doing in 25 years when I saw people speaking to the class. And it's been a real blessing for me to be an investor, to have chosen the career that I've chosen. And if the truth be known, 80% of my career has been luck. There's been some hard work, but I've been very fortunate to have been, one, get a job in the industry when I did, and then to work and be mentored by some excellent people, and in particular one, Prem Watts, who is the big supporter of the program here. So again, thank you very much. It really is an honor. I'll talk today a little bit about my background. We'll talk about our core business beliefs and investment philosophy at Patient Capital. What I think the key investment beliefs are that we follow. How do we generate ideas? How do we actually go about and identify and find investment opportunities? I'll talk a little bit about how we try to invest. And what I've labeled here is, we view investing in equities, we try to turn the process into investing in a bond-like type of security. Then I'll talk about security and financial analysis, which I think is critical. I talk about the sell discipline on its own because I think it's an extremely important part of the process. A lot of times that's the end of the process, so people think it's done. We think the sell process is just as important as the buy process. We'll talk a little bit about an example that we currently see as a value opportunity. Talk a little bit about why value investing as a discipline is difficult to actually implement. And then we'll have some questions and discussions. George advised me to hold off the questions until the end. So if you do have questions, please write them down so you don't forget them as I'm talking, and then we'll deal with the questions at the end of the presentations. And please do not be afraid to ask questions. I think that's the most interesting part of the discussion, and that's where we all learn, including myself. I started Patient Capital in 2000 with two partners. Our mandates are the standard type of mandates. High net worth individuals. We have some family offices, foundations, and mutual funds. The key point here is that all of our mandates and all of our clients buy into our philosophy, and that's critical for us. We have a singular investment philosophy that we won't compromise. And that's critical, I think, for our success and the success of really any investment firm. We don't want the investment philosophy to be diluted or distracted by competing client demands and competing demands on our time as we try to service or fulfill different mandates. I have a CFA. I did that right after I graduated. My first boss called it a union ticket. It's an important designation to have if you want to get into the investment business, and it's just now a necessity, and I believe you have to have it if you want to be licensed as a portfolio manager. And I graduated from Ivey in 1987. This is our long-term performance, and the next two slides will show the performance, and the only reason I put it up here is to show you that it can be done. There's a lot of discussion in academic circles, in particular, about efficient markets, and that over the long term, investors of any type can't really beat the market. We're a small shop, we're not big, and yet we can produce these results. And the results we've been able to produce are, I think, largely because we can stick to a discipline and a philosophy that's easy to follow, predictable, and repeatable. If you look at our returns on a compound annual return basis, again, we've managed to beat the index over all those time frames. And we've done it with a substantial portion of cash in the portfolio. So you can see in 2000, from 2000 all the way to 2008, the green is our holdings in cash or T-bills. So there's a substantial portion of our portfolios that were invested in cash and T-bills up until 2008. And it averaged approximately 75% in that time frame. So 75% of our portfolio for that time period was invested in cash. And yet, we were able to produce these returns. And these returns are total portfolio returns. So if you do some quick math, you can see that the equity portion of our investment portfolio did extremely well. So the black line is our equity return. So if you just took the equities, the securities that we invested in on their own, that would be the return that they generated. And the green line is the index. Now again, the reason I put this up there is to show you that it can be done. And tonight, going forward in this presentation, I will talk about why we think we can do it and why others who follow this discipline can do it. I always talk about these core business values. And when we started the business, we implemented these values as a product of who we were as people and our beliefs. But the more I do this, and the more we have our own shop, and I look at others and reflect on the business and the investment industry, I think these core values are just as important as the investment philosophy. Because if you don't follow these core business values or these core principles, the investment philosophy won't have a very strong root, and it can be compromised, and it can stray. So for me, over time, I've come to believe that these core business values are just as important to us in achieving our investment returns as our investment philosophy itself. And so the first point here is, we're a fiduciary first and foremost. Everything we do is directed at earning a superior rate of return for our clients. We don't care about the size of our business, the profitability of our business. We have turned away business where we felt that the client didn't suit us, the client wouldn't buy into our philosophy, the client had asked us for a different mandate. We simply will not compromise on our investment principles and our philosophy because we believe that we're a fiduciary first and foremost. Secondly, right from day one, we had the second principle here, that shareholders in our company have to have all of their personal investments invested in exactly the same way as our clients. This was the only way I thought that we can align the interests of the clients and the shareholders of the firm in one. And that's, again, extremely important because you don't want an investment manager doing something different with his money than he's doing with his client's money. And so we're all in it together at PCM. If we lose money, the clients lose money. If the clients make money, we make money. And that's a critical element of what we do because, believe me, when you've got your money on the line and you've got your entire family's money on the line, your approach is a lot different than if you're doing it just for the clients. And then finally, we want to be low cost and we want to have a small team. And again, this is extremely important to us. A small team is I think, imperative in a successful investment operation, which is contrary to what most would argue and a lot of the industry would argue. They believe that a large team gives you more resources, gives you more opportunity. I think it's the exact opposite. And I have a saying that the intellectual integrity of an investment process is inversely proportional to the number of people involved. When you have a large team, you invariably make compromises. Most of us like people. Most of us want to keep our employees happy. Most employees want to feel like they're contributing. So if you have an investment team of several people and you're the manager and you're telling them no, 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 no every time, you're going to have a pretty disgruntled group. You're going to have a lot of turnover and you're going to have an unhappy shop. So from our perspective, having as a small group as possible is critical. It eliminates the time for me to manage a team as well. And that's just as important, because I think you want the manager managing the portfolio and managing money and not really managing people. So a small team is extremely important on the investment side. And then on the operations side, we by nature are very cautious and very frugal. So we want to keep the number of people in the entire firm as low as possible, so that we don't have a huge overhead, so that if we were to lose clients, it wouldn't affect us. And I was telling George over dinner that at our firm we have 2 years of revenue in the bank. We never want to be in a position where we feel that we would have to take on business that we don't want to take on just to keep the doors open. So we manage our business in a very, very conservative way. And again, these principles, I think, allow us to invest or maintain our investment discipline without compromise, without worry about what the clients think, without worrying about whether we're going to lose a big client because we have short-term performance issues. And so in the long term, I think having very, very strong business values in an investment organization is as important as having a sound investment philosophy. So what is our investment philosophy? And this is really the core of what, when we show those returns, this is what really generates those returns over the long term. So the first point we want to make is that we believe in a long-term invest in absolute value investment philosophy. And so what that means to us is that we will only invest in securities that meet our criteria for both quality and value. In investment philosophy, and even in the value investing subcategory, you have what's called relative value investing. And relative value investing simply means that if you have two securities, pick two banks, for example, say one security is the Bank of Montreal is trading at 1.8 times book value, and the Bank of Nova Scotia is trading at 2 times book value, and the Bank of Montreal has a slightly higher yield than the Bank of Nova Scotia and a slightly lower PE. But they're both expensive. You know that as a manager. You know that they're above their long-term averages. What the relative value investor will do is they'll say, I have to be fully invested. I have to have a fully invested portfolio. So I'm a value investor. So I'm going to choose the Bank of Montreal because it's cheaper. It has a lower price to book. It has a slightly lower PE, has a slightly higher dividend yield. So I'm going to invest in the lesser of two evils. What we have said right from day one, and this is part of our investment philosophy and our investment policy statement, quite frankly, is that we say if we can't find anything that meets our criteria, our default position is T-bills or cash or some fixed income security. And so in that case, we would say both are great companies. However, both are very expensive relative to where we think they should be bought and where we think we could earn our required rate of return. So we would say Bank of Montreal is a little bit cheaper than the Bank of Nova Scotia. However, both are expensive and we do nothing. We think that relative value investing outperforms regular investing or growth investing over the long term. However, we think that absolute value investing earns greater rates of return over the long term simply because you don't have to be fully invested all the time. Our second tenet is that the preservation of capital is critical. We do not look at how much we can earn when we make an investment. We always look first and foremost at how much we can lose. So if there's a probability of loss, we walk away. And I'll talk a little bit later about why the preservation of capital is so critical and try to put it in concrete terms. But the preservation of capital is critical, I think, to any investment-based philosophy or any value investment-based philosophy, and it's critical to earning long-term rates of return. I'm sure you've heard the word margin of safety several times in your course. We purchase with a margin of safety, and that again simply means that we want to purchase security at a cheap enough discount to its intrinsic value that the probability of the loss of capital is low, and that in essence, if you've made a mistake on the business or the management, you can still get out of your investment with your capital intact. When we buy something, typically it goes down. After our initial purchase, it goes down, so we average down. So our typical objective is to invest 5%, 20 securities in a portfolio. We start with a 2 to 2.5% position. And because we're buying stocks, value investors buy stocks that are out of favor, that the market doesn't like, that there's a short-term issue for some reason, the stock continues to go down once you buy it. You cannot pick the bottom. So you start at 2% or 2.5%, and you average down so that your average cost by the time you're done is somewhat lower than when you started. And we want stocks, believe it or not. People, our clients laugh. They've sort of come to learn that we want stocks to go down after we buy them, because we want to average down. So for us, when we initially buy the stock, we expect it to go down and we want it to go down, but we're not afraid of price movements. Price movements are irrelevant to us. Short-term price movements in the stock market or in security that we're interested in are irrelevant to us, both on the short term, on the upside, and in the downside, and on the downside in the short term. When we make an investment, we're not buying a piece of paper. We are buying a fractional interest in a real living business. That's the essence of investing, and that's, if you read what Warren Buffett and Ben Graham really taught at the beginning of when they were the first in particularly Ben Graham in starting this whole notion of value investing, that was probably the biggest intellectual leap that I think he made when Ben Graham said you're buying an interest in a business. And today, with computer trading and momentum and everything else, people forget that they're actually buying real live businesses. These pieces of paper that you're buying represent a real business with people making a product, and all the pluses and minuses that go with that business, but you're buying a business. And so we, although the security, the price of the security is something that you can analyze, what we really think is important to understand is that you're buying a real living, breathing business with the potential to grow or with the potential to have serious problems, and that at any particular point in time, that piece of paper and the price that the market places on that piece of paper may be grossly inaccurate on the upside or the downside, and occasionally at fair value. And then finally, what we like to do is we like to keep things simple in our equity investments. We like to avoid complexity in the selection of equity securities in everything that we do. Because again, our objective is to minimize risk, is to preserve capital. And when we look at investments or potential investments, we believe that the simpler the business, the easier it is to understand, the less complex the accounting and the financing and everything else, the lower the risk. And so what we try to do is try to find investments where complexity is absent. So in doing what we do have some key beliefs. And I think all value investors have these beliefs, or else they wouldn't be doing what they're doing. But the first is that, obviously markets are not efficient. And that is the dominant academic theme that's filtered through the investment business for a long time, and through people who study investments. We simply don't agree with it, and I'll talk a little bit why. We define risk as the potential for the permanent loss of capital, not the volatility of the share price. As I mentioned earlier, the volatility in the movement of a share price in the short term is irrelevant to us, and in effect has no real grounding to what value is, to what risk is, and to what the real underlying activities and value of the business are. We think that there are only two things that one has to focus on when investing. One is valuation, what's the business worth and what are you buying it at? And then what's the quality of the underlying business that you're purchasing? Those are the two key fundamental issues that I think one should focus on. If you deviate from anything, from those two big picture items, I believe that anything else is speculation. So if you're looking at momentum, if you're looking at the next great growth stock, if you're looking at technical analysis, in my view, and I stress my view, there are others who will argue differently, but in my view, all those activities are speculation. And then finally, and this is important as well, time is critical. Time is a critical element of success. And in the investment business, it's my very strong belief that the longer your time frame, the more your competitive advantage is. So for us, a very long time frame is extremely critical to investment success, and it has been to our success. So let's talk a little bit about why we think markets are not efficient. You got to believe that markets are inefficient, or you wouldn't do what I do. You wouldn't be here. George wouldn't be doing what he's doing. It's a fundamental belief. You've got to believe that at different points in time, the securities market misprice an investment opportunity. That's fundamental. If you don't believe that, you shouldn't do you shouldn't even consider a career as a value investor. Secondly, it's not intuitive. Think about it. If efficient market theory is correct, IBM is trading at 200 at 9:30 in the morning, and at 2:30 it's trading at 180. That's a 10% drop in business value in the matter of 8 hours, in the absence of any substantial event. And that happens a lot. How could a business like IBM or any other business change its intrinsic value in a very short period of time, and even in seconds? So IBM could go from $200 to 202 to 195 in the span of an hour. How can a business change its value, its intrinsic value, in that very short period of time? It doesn't make sense. It's like if you owned a car, and in the morning someone said to you it was worth $10,000, and then at 12 noon someone said it was worth $9,500. It doesn't make sense. So efficient market theory is not intuitive from a practical sense, from a practical point of view. I'm sure George has talked about, and you've read some behavioral finance. They're starting to make some interesting findings and discoveries that, yes, indeed, people don't always act rationally, and that there are different emotions at play when they're investing, and they impact securities markets both in the short term and in the long term. And then finally, the proof's in the pudding. There are many, many studies that show that value-based investment philosophies outperform the market. So you can go and you can look at the Bear of Value Index, for example, and you'll see that over time it's outperformed both their growth index and the overall market as a whole. Several studies show that net working capital-based strategies do produce a superior rate of return over time, or that low price to book strategies outperform the market over time. So there is actually empirical evidence that suggests that value investing works. So why does this happen? Why are there opportunities where markets are inefficient? Why do inefficiencies occur? Well, the most fundamental one is simply, and you've all heard it and you've all read it if you read a lot of the value investing books, a lot of the value investors' comments, they will talk about fear and greed. And in the end, that's really, in some ways, as simple as it gets, fear and greed. So the most basic one for most people is they're afraid of losing money. So when a stock goes down, they overreact and they will sell it because they think, oh my God, something's wrong. Or they want to make money and they see something going up and they want to jump on the bandwagon. From a business's perspective, investment firms are afraid of losing assets. They're afraid of losing clients. And the investment business, quite frankly, is a very profitable business. The economics of the investment industry are such that if you gain enough assets, the business itself becomes extremely profitable. And you've heard about a lot of people who grow these firms to billions and billions of dollars that make a lot of money. So one of the motivations is, I don't want to be too far away from the index as a firm. I don't want to be too offside, because I don't want to lose clients. On the other side, again, markets are up. You want the hot product. You want to gain assets. You want to gain clients. So you invest in whatever's going up. And then on a very personal level too, as well. People running money are afraid that they will lose a job they love, a job that pays them a substantial salary, a job that's challenging. So again, what's the best way to preserve your job? is not to get too far outside the mean on either side, particularly on the downside. So when the market's down or when the market's up, you don't want to, you don't want to be lagging the market by any substantial amount. And so for all those reasons, markets and people behave in a way that are not efficient and that create opportunities for people who have the right incentives in place, for people who have the right time frame, and people who aren't afraid to go against the crowd. Another reason, and it's becoming more and more so, I think, many investors, both on the individual side and on the institutional side, have very short time frames. And again, going back to the point I made earlier, a long-term time frame is extremely critical for investment success. There's no way on earth that I think even a 1 year, let alone a 6 month or a 3 month or a 1 day investment time horizon for any investment is long enough. But believe it or not, people have very, very short time frames, and if something doesn't perform in the short term, they dump it. So again, that creates market inefficiencies. The greatest market opportunities that we found are created by three causes. One is there's a market decline, the whole market falls. So under that scenario, there's a lot to invest in across a broad spectrum of industries. Secondly, there could be industry-specific concerns. So, for example, a couple of years ago, there was a lot of concern about what healthcare reform would do to the healthcare industry in the United States, and so a lot of companies in the healthcare industry got hit. And then finally, company-specific events. Sometimes a company will have a problem that the market overreacts to. They may miss earnings. They may have some short-term production problem. They may lose a key executive. There's a whole range of company-specific items that may cause investors to overreact in the short term and give the long-term value investor the opportunity to invest in that specific security. So again, market efficiencies occur largely because of fear and greed, because of short-term time frames, and for all those three specific market declines, broad industry concerns, or company-specific events. So here are some examples of market inefficiencies. And at the time, when you're in it, it all makes sense. And then you step back and say, wow, that doesn't make sense at all. The Japan bubble of 1989. In 1989, the Japanese index was trading at about 40 times earnings. And I remember, at that time, I'd only been in the industry for 2 years, and I'm thinking, this doesn't make sense. The explanation was that Japanese accounting was different, so therefore, the PE ratio doesn't count. They had to look at something else. During that time, I remember reading that the Emperor's Palace, the property that the Emperor's Palace sat on in Japan, was worth more than the entire state of California. Can you believe that? A small parcel of land somewhere in Japan is worth more than the entire state of California in 1989. Doesn't make sense. In 2000, there was an internet bubble, so you had companies of all sorts that were supposed to profit and benefit from the internet, trading at tens of hundreds of times earnings. And so one of the interesting things was they didn't have earnings. So all of a sudden, it's, we're going to do it on a multiple of cash flow, but they didn't have cash flow. So we're going to do it on a multiple of revenue. They didn't have revenue. So now we're going to do it on a multiple of eyeballs. Can you believe it? They were at that time valuing how many people were looking at the website to value investment companies. Again, a huge market inefficiency. In 2007 and 2008, U.S. financial institutions were bid to crazy levels because the U.S. housing market was considered to be going on an upward trajectory that wouldn't end. They were making loans to people that couldn't pay. They were making loans on values that were clearly unsustainable. And yet, these companies, particularly financial companies, were bid to astronomical valuations. We probably have something similar here in Canada, as George has written about. I believe that, and I agree with George, that in Canada the housing market is probably overvalued and due for a correction at some point, and probably be a bigger correction than people anticipate. And then if you just look at simple or specific company situations, Nortel at 40% of the index. Nortel was at one time 40% of the index. I remember not buying it at the time and getting greatly chastised and criticized for not investing in Nortel when it was 40% of the index. Some of my relative value investing friends, they invested in Nortel. They invested only 20% of their fund in Nortel and said, I'm a value investor because I'm only 20% invested. They lost the whole 20%, but they outperformed the index. Enron, another company that was went to zero, and at one point was extremely highly valued. GM essentially went to zero. Those are all, in my opinion, excellent examples of why markets are inefficient. How can something be worth billions of dollars at the market close and then the next morning be worth zero? It doesn't make sense. So we strongly believe that markets are not efficient. We strongly believe with the right philosophy, the right approach, and the right structure in place that you can take advantage of these inefficiencies and make long-term returns that are better than the markets for your clients. Here are some examples of some of the inefficiencies we've capitalized on. Some of these names may not mean anything to you, but I'll give them to you as an example anyway. Franco-Nevada was a gold royalty company. It essentially got a royalty every time somebody mined and sold gold. When gold hit $200 an ounce, the value of the shares of Franco-Nevada, which was in early 2000, went down to their cash value. So people sold off the shares of Franco-Nevada, a company that had incredibly attractive business characteristics, down to the cash value on the balance sheet because they thought that the price of gold would continue to fall. We purchased it at cash value, this incredibly attractive business. We purchased Inmet mining convertible bonds at less than the cash value on the balance sheet. So at the time, I think the whole issue of convertible bonds outstanding was about $90 million. We were able to purchase these bonds in the market at 60 cents on the dollar. And Inmet, a mining company that's being taken over, you may have read about it in the news lately, Inmet had over $100 million in cash on the balance sheet to buy back these bonds. In essence, we were buying 60 cents, we were buying a dollar for 60 cents in real terms. Cogeco Cable is a cable company. Obviously, we were able to buy it at 40% of book value. The reason, when we were purchasing Cogeco Cable at 40% of book value, there was a company in the United States called Adelphia that turned out to be to go bankrupt. They were a cable company because they had some issues with their accounting and debt and so forth. And yet everybody assumed that all cable companies were in the same boat as this company in the United States. So again, another example of people overreacting to a situation that had nothing to do with our particular investment. In the last financial crisis in 2008, we were able to buy the Bank of Montreal at a 9% yield. An incredible opportunity. Why? Because people were afraid that all financial institutions were going to go to zero. So think of the intellectual inconsistency of that. You think that all financial institutions are going to zero, and yet you're buying other stocks in the market. Well, if all financial institutions are going to zero, you shouldn't be buying anything because you're heading for a Great Depression. So when you see intellectual inconsistencies in the market like that, that provides a great opportunity. It doesn't make sense to believe that all financial stocks are going to zero and yet think that you're going to have a viable economy going forward. The two don't go hand in hand. And I found that if you can identify these intellectual inconsistencies, it's usually an opportunity to make money or an opportunity to get out of the way because this thing's going to fall apart sooner or later. And then just recently, we were able to buy some high-quality U.S. banks at a discount to either their book value or the tangible book value. So The most recent example, we were able to buy JP Morgan at below its tangible book value because people were afraid that they'd incurred this humongous trading loss in one of their derivative trading operations. As it turned out, they lost about $6 billion or so in the quarter, which was, in essence, one quarter's income, but not enough to threaten the viability of the institution or to threaten the long-term value of the shares. So we purchased it. We were able to purchase this high-quality U.S.-based financial institution at a substantial discount to its book value. So again, if you're diligent, if you wait, and you're patient, these opportunities do come up. And when they come up, you have to have the courage of your convictions and the ability and the client support to actually make the purchase decision. So how do we define risk? And again, I can't emphasize this enough. The essence, I think, of value investing is to minimize as much risk as possible. And the paradox of that is that in minimizing risk, in wanting to preserve capital and in focusing on not losing the money, the returns in the long term are substantially higher than any other strategy available out there. So we focus on risk. That's what we are. And I like to think of us not as return generators, but as risk managers. And so we define risk in a very particular way. We define risk as the permanent loss of capital. If we buy something at 10 and it goes to 5, we don't care because we believe that the underlying business is worth 20. And so in the short term, like I said earlier, the share price has no reflection on the true intrinsic value of the underlying business and the potential long-term return. However, if you buy something at 10, either because it was a low-quality business or because you overpaid it and it goes to 5, you may never get your 5. You may never get back to 10 because the valuation was way above what it was really worth, or the business that you bought was fundamentally unsound. So, purchasing at a substantial discount to its intrinsic value is critical when you are sure that one, you've got a strong estimate of what it's truly worth, and that you've got a strong business. So the investment community, for the most part, and the consulting community who are associated with these large pension plans and clients will define risk as volatility. And volatility, as you know from your courses, is a statistical term. And what they look at is how different are your returns relative to the index. And so if you can believe it, when you look back at that chart that we showed you, that I showed you right at the start, we have a portfolio of 70% cash. And yet, according to these measures, our portfolio is riskier than the market, if you can believe it. Some would argue that according to that definition of risk, volatility relative to an index, our portfolio is riskier than the market. We don't understand that, but that's what it is. We're very different, and again, that's why I think value investors can earn the substantial rates of return, because we don't care about these types of benchmarking or measurements. So how do we reduce risk? The first one is to purchase with a margin of safety. Again, that means if something is worth 10, buying it at $5 to $6. And if you buy something at a substantial discount to what it's worth, you've already minimized your risk, because let's say you're wrong or management does something to reduce value. It's unlikely that the value that's destroyed or that you made the mistake on is a 50% reduction in value. So even if it is 50%, you bought something at 5 that you thought was worth 10, if you made a 50% mistake, you still get out with your capital intact. And that's critical because you're going to make mistakes. Investors make mistakes. It's a fact of life. If you're going to be a professional investor, you have to be able to live with the fact that you're going to make a mistake. It's like the baseball hitter. If he's hitting 350, he's doing great, but he's going to miss, or he's going to strike out 6.5 times out of 10. And he's got to be able to accept the fact that he's going to strike out several times. We try to minimize the number of mistakes we make, but that's why we purchase with a margin of safety. And it's a humility and it's an understanding that investing is very difficult and that we're not always going to be right and that we don't have all the answers. Warren Buffett says that the true way to reduce risk is not through diversification, but through knowledge and study. So the more you understand the investment you've made, the more you understand the underlying business that you've bought, the more that you understand the valuation and how you came to it, the safer your investment is. Investing in 100 securities where you know a little bit about each one, in my opinion, is a lot riskier than investing in 20 or 25 securities where you've studied each security in depth and you've done all your work and you bought it at a substantial discount to its intrinsic value. So diversification in and of itself is not a, in my opinion, does not reduce risk. We also try to reduce risk, again, going back to this whole notion of value and quality. One, we want to buy stocks that are cheap, at a substantial discount to what it's worth, and then we want to buy high quality businesses as well. So the combination of the two we found has truly, truly minimized risk. You're buying something cheap, and you're also buying a high quality business. And when you combine the two, the potential for the loss of capital is extremely low, and the potential returns are extremely high. So you've created, in my opinion, something that the academics say you can't do, the efficient market guys say you can't do, is you can create, or you can have substantial long-term returns with less risk than the market as a whole. So again, value and a quality business, and we'll talk about that in a moment. The combination of the two reduce risk and reduce the potential for the permanent loss of capital. And then finally, a long time frame. Typically, when we make an investment decision, we expect the investment thesis and the share price to appreciate to our value or expected value over a 5-year period. The life cycle of investment that we've experienced over time has been that in the first year that we buy it, it goes down from our purchase price. In the second year, it meanders sort of up to it. So after 2 years, we're basically zero. In the third year, it starts to go up and may perform with the market. And then in years 4 and 5, it finally gets to our target value and our intrinsic value. And in years 4 and 5 is typically when it doubles. So over a 5-year time frame, that's approximately, with the dividend included, that's approximately a 20% compound annual rate of return. But you've got to have that long-term time frame, because if you recall, I mentioned in the first 2 years, the stock does nothing. So if you're impatient, if you've got clients who aren't supportive, if you've got all these performance pressures, this isn't going to work. And it's very, very difficult to have a value-based investment philosophy that doesn't have an accompanying long-term time frame with it. And then finally, as I mentioned earlier, diversification, in our opinion, does not reduce risk. All these other factors do. Cheap price, know what you're buying, and buying a high-quality business. So why, all the value investors talk about why the preservation of wealth is critical. And when I talk to our clients and when I talk to people, and you make the statement, or I make the statement, and they kind of look at you blankly and they nod, but why is it so important not to lose capital? And if you put some meat on it, it's simply the mathematics of investing tell you that losing money is extremely harmful to long-term investment returns. So first of all, you can't compound money that you've lost. So there's a huge opportunity cost to losing capital. So if you start with $10 and you end up with $5, it takes a lot of excess compounding to catch up, or excess returns to catch up and make that $5 that you lost and all the money that you could have made on the $5 that you lost. So there's a huge opportunity cost to losing capital. Secondly, it's very, very difficult to recoup your losses. So if you lose 50%, you need 100% return to get it back. And believe me, 100% return is very, very difficult to get. 50% is very, 50%, a 50% loss is very, very easy to achieve. 100% return is very, very difficult to get back. So it's just the math of investing. If you start with 10 and you go down to 5, you've lost 50. To get back to 10, you need 100. It's very, very difficult. And then finally, and just as importantly, when people lose money, their behavior changes. Psychologically, it's very, very difficult to stay the course. And that's just as important as the other two, because you've got a value manager, you've got an investment strategy, and the worst thing you can do is change course at the very, very bottom. And if you do that, you've essentially locked in your losses. So losing money is extremely, extremely painful and harmful to long-term capital creation or to long-term wealth creation. And that's why we try to avoid it for all those reasons. And we spend, as I keep on saying, we spend a lot of time, and I can't emphasize this enough, that the preservation of capital, the reduction of risk, is, in our opinion, far more important than the generating the returns. The returns will take care of themselves, believe me, if you've got this philosophy. So when we look at investment, of course, the price you pay for investment is extremely important to your investment return. And the return is directly related to the price you pay. And I'll put some numbers to that in just a moment. And we keep on going back, as I'm sure if you look back at all the videos of the previous speakers who've spoken to this class, value investors talk about the margin of safety. And that margin of safety is critical to the investment process. And then again, this allows you to earn substantially superior rates of return with less risk. If you're buying something at half of its price, you're reducing your risk substantially and at the same time giving you the potential to double your money. The markets don't give you those opportunities on an aggregate basis, but this philosophy allows you to do that. And then why is the quality of a business is important? We think it's extremely important, and we've migrated to the point where we will only invest in what we think are high-quality businesses. If some of you have read, anything that Warren Buffett has written or Benjamin Graham, Warren Buffett talks about cigar butts, and cigar butts are basically low-quality businesses that trade at a very low valuation. And so you can buy a low-returning, highly levered, poorly managed company at net working capital, and you can make money on that. What we've decided to do at our firm is say, that's not the area of investments we want. We want to make sure, because those investments are too risky, and for that strategy to work, you would have to have 100 of those types of investments to work. What we say is, we want to stay away from the cigar butts, we want to stay away from the low quality businesses, and we want to only focus on those businesses that we think are high quality. And why do we do that? First of all, the business risk is reduced. So again, when you're making an investment in the stock market, you're buying a real business. So obviously, the higher quality business that you buy, the lower the risk, the lower your business risk. Now, one of the things that people get confused on is that high quality businesses can be bought at substantial premiums in terms of valuation. So in the 70s, there were what was called the nifty 50s. And in the 70s, there were these 50 great stocks, IBM, Coca-Cola, McDonald's, you name all the brand names that you can think of today. And because they were these great businesses, and it's people who analyzed them and called them great businesses were absolutely right. If you look at where these companies were then and where they are today, they've grown 100-fold in both sales and profits. Yet the people who invested at 100 times earnings in those businesses lost a lot of money. So don't ever get confused or don't ever fall in love with a high-quality business and not worry about the valuation. If you want to be a value investor, you should always look at the valuation as well as the quality of the business. High-quality businesses perform better over time just as a business. So again, it reduces risk, gives you a better rate of return. And then, because it's a high-quality business, you have time. You have time for the investment thesis to work out. So, for example, if you were to buy, say, Coca-Cola, for example, say Coca-Cola had some huge short-term problem. One of, heaven forbid, one of their products got contaminated and a lot of people got hurt. In that scenario, the stock of Coca-Cola would go down quite dramatically, and the valuation would then be at a substantial discount to what it is today. It would take time for the business and the managers to work through that scenario, And because it's a high quality business with a strong balance sheet, with a strong franchise, you've got a long time for that thesis to work out. Conversely, if a similar situation happened to a business that was levered, that didn't have a strong franchise, that didn't have strong management, all those negative things that you might associate with a business, your risk would be very, very high under that circumstance, because the probability of the business being able to survive would be low, and your time frame in seeing that business turn around would be a lot shorter than if it had all the positive characteristics of something like a Coca-Cola. So here's some examples of high quality businesses versus businesses that aren't so strong. So this may have changed, but back in 2008, you had Toyota versus GM. In Canada, you had the Hudson's Bay Company versus Walmart. I remember investing in Hudson's Bay when Walmart announced that they were coming into town. The stock got hammered. And I remember saying, well, Walmart can't come in and take 60% of the market. They did. And the reason, Walmart was a very, very strong company. Stelco versus Dofasco, the two Canadian steel companies that are now foreign owned, but Stelco was always the highly levered, high cost producer. Dofasco was always the company with a strong balance sheet and low costs. But again, these are just different examples of companies where one is a high quality company that survived some issues, and the other was not so strong and didn't survive or didn't perform as well. So quality of a business is extremely important in the investment decision, because it gives you that time for your investment thesis to work out, and it reduces business risk. So even when it comes to valuation now, and this is almost, I would have thought 15, 20 years ago that I would never be saying this, but we would prefer a slightly more expensive valuation on a high quality company than a lower valuation on a low quality company. So if we had the opportunity to invest in, at 50% of book value in a low quality business, or 80% of book value in a high quality business, 20 years ago I may have thought about and looked at it very closely and maybe even preferred the 50% discount to book value in the low quality business. Today we simply won't do that. Today we will take the 80% price to book value in the high quality business and not even consider the 50% discount to book value in the low quality business. So why is a long-term time horizon critical? And I think one of the key success factors that we have at Patient Capital is that we've managed to educate our clients and are truly grateful to our clients because we do have this long-term time horizon, and they give us the opportunity to invest in a way that allows our investment thesis to materialize over a long period of time. So first of all, as I mentioned, it allows your business or valuation thesis to materialize. It's not going to happen overnight. I can't emphasize enough that usually an investment thesis takes 3 to 5 years to work out. A long-term time frame, it reduces your trading costs and is very tax efficient. One of the biggest costs in portfolio management is trading costs, and there's all sorts of studies that show that trading costs reduce portfolio returns by anywhere from 1.5% to 3.5% annually. So if you can reduce your turnover, you can reduce those trading costs dramatically and improve your returns quite dramatically over time as well. It reduces activity. So a long time, if you're not trading all the time, if you're not running around trying to figure out what's going up or down every minute, it reduces activity. I like to say it just gives us more time to think. And when George and his colleagues came to our office some time ago, nothing happens in our office. It's not a very exciting place. It's like going into a library or you're watching the paint dry. We're not an exciting place to hang out, believe me. But it does give you time to think. A long time frame and a low turnover strategy does give you time to think and ponder what you're doing. A long time frame also allows compounding to work. And Albert Einstein said that compounding is the 8th wonder of the world. And he's right. I mean, today I'm still amazed when I look at some of our clients' assets and see that when they started with us in 2000, their money has more than doubled. And it's just that slow, steady compounding. And it doesn't have to be huge, huge numbers. It just has to be slow, steady, and consistent, and over a long period of time. And just by just allowing it to compound over that period of time, you've essentially, without even realizing it, over a 10, 12-year time frame, you've more than doubled your money. And then finally, we think it's a huge competitive advantage if you can lengthen your time frame relative to your competitors. Because again, short-term time frames make you behave in a very, very, in my opinion, non-economic way, and sometimes an irrational way. And when we can say, we can buy this company at 7 times earnings because we can wait 5 years, the guy who's selling it at 7 times earnings has at a huge disadvantage because he can't wait till next quarter because he's afraid that he's going to underperform. And if he underperforms, his firm will lose assets, his boss will get mad, or he might even lose his job. So when you can create an environment where you have a long-term time frame, I think it's a real, real competitive advantage. So how do we do this? How do you find these ideas? And it's, it's a very standard approach. There's not a lot of magic to this. There's not a lot of, intellectual horsepower that's involved in coming up with ideas. The biggest way we do it is we do a valuation every morning, come in, turn on the computers, and they spit out stocks that are trading at our criteria: low price to book, low PE, low price to cash flow, high yields. And it's just simple. So we're looking for those statistical characteristics, and I stress, just as a starting point. Once we identify one from those screens, then we do all the work, and from many other these other methods that we use to identify cheap stocks. We've been doing this for 25 years, so we do have, a database of companies we've analyzed and looked at, and we have estimated intrinsic value for about 300 companies that we think are high quality, we'd love to buy at some point. And so we monitor the price that they're trading at in the market relative to the intrinsic value we've estimated over that time frame. We look at Value Line. I'm sure you're all familiar with Value Line. It's another great source of quick information that provides statistical summaries of the companies, and we flip through those. One of the important things that I think I've always done and has helped me is just I read a lot. And so you read the newspapers. I've read Business Week, Fortune, and Forbes ever since I was, believe it or not, ever since I was about 16 years old. Not the most exciting guy in the world, but I've read those, and those have really helped me just pick up ideas and learn about business. And they are a good source of ideas. And then finally, just listening to others. You go out, you listen to people on TV. I'll go out with other value investors and chat. And value investors as a group are pretty thoughtful. They're pretty careful. And so it's always good to hear what they have to say as well. So we generate our ideas through a variety of means. And that's just the starting point, is just how do you find an idea and where do you start? This is the critical part here of what we do, I think. Security analysis is really what it's all about. We can talk about the philosophy and the framework and the underlying principles like I mentioned. They're pretty generic. In the end, you have to make an investment decision, and you have to choose a security yourself. And I think that that's where the competitive advantage and the real return lies relative to other people who value, who invest in any type of philosophy, and in particular in investing, in value investing. Because in value investing, what you're doing is you're buying something out of favor. So the real skill comes in out of that subset of low price to book or low PE stocks or high dividend yielding stocks. Out of that value subset, the real skill and the real value added comes in choosing the securities that, one, are truly undervalued, and two, will outperform both that subset of value stocks and the index as a whole. And I think being an Ivey grad has helped me tremendously in this important skill. Because at Ivey, what we do is we study cases and we take an integrated approach to looking at businesses. And when we look at businesses, and when you do security analysis, there's far more to the security, to analyzing the security than just looking at the valuation or looking at its finances. So when we go and visit companies, we spend no more than 5 to 10% of our time talking about the finances or the accounting. We really spend most of our time talking about internal controls, inventory management, marketing strategies, people issues, all those types of things that you learn here on an integrated basis, all those issues and different functional areas that you learn here to integrate are critical. And that's why I think people who study at Ivey have a very, very strong advantage relative to others when it comes to security analysis. So the combination of the program with George's course, I think if you come into this area and practice it with some discipline, gives you a real leg up on your competitors. So when we look at securities, we're trying to turn an equity security into a bond. That's what we're really trying to do. We're trying to take an equity and turn its characteristics into bond-like characteristics. And so why? Why do we do that? Well, if you look at a bond, the potential for the loss of capital is minimal if you hold the bond to maturity. Bonds have very predictable cash flows to investors. We're looking for companies that have predictable cash flows. The investment return clearly depends on the price you pay. A bond is very easy, and I'll go through it in a second, but it's very easy to determine your return on a bond by the price you pay. You know it, we're going right in. They're very easy to understand, and as I mentioned earlier, when we look at equity investments, we want to make sure that we are minimizing the complexity of the investment. Then finally, most bonds are long-term dated, and so they have a long-term horizon. And if you look at those concepts, they're all focused and they're all consistent with the value investing philosophy. Margin of safety, price depends on return, long-term time frame, or price determines your return. So again, very, very straightforward, but conceptually, by doing this, it really locks in the notion that your return is dependent on the price you pay. So if you have a bond that has $10 that pays $10 in interest, you pay par $100, it's a 10% return. If you pay $50 for that bond, half, you get a 20% return. If you pay $200, you get a 5% return. Very, very straightforward. That's what we do with equities. You want to make sure that you understand that the price you pay for an equity determines the return you're going to get. It's critical to understand. I can't emphasize that enough. If you're paying 30 times earnings for something, the return you're going to get is going to be a lot different than if you're paying 5 times earnings for something. The price you pay for an investment determines your return. So you take a look at it and you say, okay, how do we do this with equities? Well, here's the formula. You guys are all familiar with the formula. Free cash flow divided by some discount rate minus a growth rate. So if you take a look, interest is equal to free cash flow. Your rate of return is your interest rate. In a bond, it's 0, so you put 0 there, but in equity, it's some growth rate. So again, very, very similar. If you look at it like a bond, you can come back to the notion that what you're paying is extremely important to the return you get. Just as an aside, this is intellectually and conceptually, it's the same as the dividend discount model, which you guys have studied, I'm sure. The next step in security selection or in security investing is to analyze a business. And again, I can't emphasize that the advantage that you guys have here at Ivey in the integrated case approach that you do. So when we look at a business, again, focusing on the fact that we want to minimize risk, is we want a business that has a long operating history. We want that long operating history because we want to be able to determine how well a business does under various scenarios, how management's behaved over a long-term time frame, how sensitive it is to different outcomes, and just the accounting and the returns it generates over a long period of time. So we won't invest in IPOs. One reason that they're always overpriced. The other side of it is that companies that just become public have no operating history to speak of that you can analyze and look at. We want businesses that are simple to understand and analyze. So we won't invest in biotech companies. We won't invest in businesses that we don't understand. We want to make sure that at the heart of what we do, we're always keeping it simple and we're always understanding what we're buying. We want companies that have very conservative accounting policies. Some of the biggest fiascos in investments in the investment industry arise out of companies that have very poor accounting policies or very aggressive accounting policies. We spend a lot of time, and I can't emphasize enough how important accounting is to understanding investing. And if you're going to get into this business, or if you're going to do if you want to be a value investor, start learning your accounting as fast as you can. It doesn't mean you need to be a CA, but understanding the accounting and studying it is critical to being a successful investor, in my opinion. We want a strong balance sheet. That goes without saying. Again, strong balance sheets give you a lot more comfort. It gives you a longer time frame for your investment thesis to materialize and work out. We want acceptable returns on equity and capital. I had high returns on equity and capital. However, in practical terms, we will make trade-offs. So if we can buy a business at 50% of its intrinsic value that has a 12% return on capital, return on equity, we will buy it. As long as the return on equity isn't near zero or substandard to its industry and its competitors, we will make that trade-off. We'd love to have a business that generates 20 or 25% return on equity or capital, but we're willing to make that trade-off because in markets, you're not always going to get the chance to invest in your 10 out of 10 companies. So you've got to make trade-offs. And one of the trade-offs we're willing to make is to have a lower return on equity that's acceptable to us, but not at the very top of what we would consider outstanding. We want a company that has a competitive position, and then finally, and this again is extremely important to us, we want free and sustainable cash flow. And I know you guys hear this word free cash flow. We're very, very strict in our definition of what free cash flow is, and I'll talk about it in a moment. Again, I can't emphasize this enough, that understanding your accounting is extremely important. So if you're going to just learn the accounting, even on your own if you have to, because it'll keep you out of trouble. And I spend a lot of time learning accounting. A lot of it was on my own. I didn't focus on accounting when I was in the Ivey program, but I did spend a lot of time going out on my own and learning about accounting issues. So here are some red flags. And what we're looking for in businesses that we invest in, that we want to avoid, are red flags. And when we find these red flags, we simply back away. So the most common red flags that alert us to real fundamental problems are a declining cash balance, because in the end, cash is cash is cash. One of the accounting professors when I was here used to say, if it doesn't jingle, it doesn't count. And in the investing world, we found that when you're out of cash, that's a real problem. Another big red flag is increasing accounts receivable inventory balances. If they're rising dramatically relative to sales, watch out. That is a huge red flag. If there are substantial and increasing soft assets, so what does that mean? It means a lot of goodwill. It means a lot of customer relationship, intangible assets, deferred tax assets. If those are a substantial portion of the balance sheet, we found that over time those businesses tend to be a lot riskier than we thought they were, or not as high quality as we thought they were. Those soft assets we think are a real red flag, and are an indicator of an issue, either in the past or in the current business. Again, if you have increasing short-term bank credit, it means you're running out of cash. That's not a good thing. If you have large current maturities. So one of the things we look at is we look at their term structure and their debt structure. And so, for example, if a company has $1 billion of debt and $900 million of it is coming due this year, again, be very careful. You want to find out how they're going to finance it. Do they have the cash to finance it? And if there's any doubt that they can match that, or that they come up with the money to pay that maturity, then again, be very careful. High debt is always a red flag for us. Sometimes a company can have high debt load, but because their business is so strong, they can cover their interest ratios their interest on a cash basis quite comfortably. Most of the time, that's not the case. So what we look at is we look at the absolute level of debt. The higher, the riskier we think it is, and the more likely we're to stay away. And we also look at what we call the cash interest coverage ratio, which means that we take its operating income, add back depreciation, subtract the capital expenditures, and see how much coverage that is in relation to the interest that they have to pay. If that's, again, low, if that ratio is low, be very, very careful. When we look at cash flow, again, as I mentioned, and I'll go through it in another slide, but we want to make sure that it's positive cash flow. And if you have negative cash flow, and we define cash flow as cash from operations minus working capital, minus capital expenditures. If that's negative, again, that's a red flag for us. That tells us that the business isn't generating enough cash to cover all of its internal needs. And when that happens, if that happens for a sustained period of time and it's persistent, that's usually a value trap. That's usually a business that will either require more debt, which increases the risk, or has to issue equity, which dilutes your long-term returns. And then finally, you get companies that report earnings before restructuring charges and then after restructuring charges. And the companies that have all these consistent or all these restructuring charges will always say non-GAAP earnings. Our EPS is $4 a share before non-GAAP on a non-GAAP earning basis, and on a GAAP basis, our earnings are $1.50. And so, of course, they always want you to value the stock on the non-GAAP EPS. If that happens over a long period of time, that number is recurring, and that should be a part of their GAAP earnings. So when you see that, a substantial recurring or restructuring charges or non-cash charges, again, be very, very leery. There's probably something that's going on in the business that, again, is persistent and not good for the business. So when you look at all these red flags, when, again, going back to my earlier point, that when we look at securities and when we look at investments, we want to reduce risk and we want to minimize risk. And that's the idea of identifying these red flags. Where are the risks? We want to make sure that we're not investing in a fundamentally unsound business. And most of these items are balance sheet items. Think about it. The biggest risk in a business is, I think, you can identify through the balance sheet, not the income statement. Most people who spend a lot of time analyzing securities spend the majority of their time analyzing the income statement. For us, the income statement is the least important statement of the three. The most important for us is the cash flow statement, then the balance sheet, and then finally the income statement. For us, short-term EPS movements are irrelevant. It's identifying whether the cash flows are sustainable, are free and sustainable, and whether the balance sheet is risky. That's what we spend all of our time on, and that's where I think we've been able to eliminate risk and mistakes in our investments. So how do we do it? When we make an investment, it's again, when you come into our offices, it's pretty boring. We're sitting at the computer, essentially reading annual reports and building models. So we build a model. We're very, very diligent in this. For every security we invest in, we build a model. We want to make sure that the models we built, we normalize the balance sheets and we normalize the cash flow statements. And we focus on cash flow because in the end, that's what generates value. Free and sustainable cash flow generates value. And if you go back to the whole notion of turning an equity security into a bond, the value of the bond is really the net present value of its interest payments to you. That's what gives a bond its value, the cash you're getting. Same with a business. A business ultimately is worthwhile, has some value because it generates free cash that can be returned back to shareholders in one form or another. We don't project or model huge growth. Our growth is very, very modest. We're very, very conservative in our assumptions. We normalize margins. If the margins are below average, we keep them at that below average rate. If the margins are above average, we drop the margins back to a normalized rate. Again, when we do things, we're looking to minimize risk, and we're also doing it in such a conservative way that the margin of safety is not only in the price you pay, but in the assumptions you make. So you're buying something at 50% of what it's worth, and that intrinsic value that you calculated is also conservatively valued or estimated. And so you get the double whammy. You get the cheap discount or the cheap price on this conservative valuation. So like I said, we focus on the cash flow, on the cash flow and the detailed analysis of the cash flow. And for us, it's very, very strict. It's a very strict definition. And there's two objectives in looking at cash flow. One is to determine the fundamental soundness of the business, and the other is for valuation purposes. When we look at the cash flow statement on the first blush, we're looking for, is this business fundamentally sound? So in broad terms, we'll take the net income, we'll add back all the non-cash charges, we'll subtract any investment in working capital, we'll subtract capital expenditures, we'll subtract any deferred charges that appear on the income statement, and sometimes, companies will get clever and they will say, our capital expenditures were $100 million, and then they'll have another line that says, deferred expenses were another $100 million. And people who look at cash flow and free cash flow sometimes will not subtract the deferred charges. They will only look at capital expenditures. We group the two. If you're investing in software, for example, even though you're capitalizing it, to us that's a cash outflow. So we subtract deferred charges out of that free cash flow calculation. We look at deferred long-term debt repayments that are required, and then we look at dividends. And so the objective here, I want to emphasize, the objective is not a valuation exercise at this point. The objective is to say, does this business generate enough cash to cover all of its requirements, all of its fundamental operating requirements? If it doesn't, then you've got a different decision. Then you say, is this a business I want to invest in, irrespective of the valuation? And what we found over time is that if it's not generating enough cash to cover all of those requirements, which I agree is, or which I admit is a very, very strict definition of free cash flow. We found though that if there's a shortage anywhere in that calculation, that in the long term the investment tends not to be a successful investment, because in essence the business isn't generating enough cash to cover all of its needs. And when you have that problem, one of two things has to happen. You have to borrow more, or you have to issue more equity, and both reduce intrinsic value and increase risk. And then the other side is the valuation. So this is, again, the net income we start with. We take the non-cash charges out, or we add back the non-cash charges. We take out the investment in working capital, the capital expenditures, and then the deferred charges, and then that equals your free cash flow, which, again, I want to emphasize it's different than the previous slide. We don't take away dividends, and we don't take away the debt repayments. So we stop at all capital expenditures, including deferred charges. And that gives you your free cash flow number. And then you discount that at some rate, obviously, and then you purchase it at 50 to 60% discount of that value. And when we found again, when we do this, and again we do it very carefully, when we do this and we get the combination of the strong cash flow on the fundamental side and the substantial discount on the valuation, the investment, if you have the long enough time frame, and if you've done that all correctly and analyzed the company properly, then the investment tends to be rather successful over a 3 to 5 year period. So here's a company that meets all that criteria, and I use this because it's a company that's familiar, and on a fundamental basis, it meets the criteria we're looking for. So Coca-Cola, if you look at it, it's long history, obviously, very simple to analyze. If you look at the accounting, it's very conservative, very strong balance sheet, great return on equity and capital. It's obviously the market leader, and then when you go through the exercise, it's got free and sustainable cash flow. And here it's finances. Again, this is a very, very simplified form of what we do, but it's there for the, we put it up for illustrative purposes. But as you can see, as a business, it covers all of its obligations. After all the requirements that it needs, it still has substantial cash flow left over. So all that is positive. So if you've got a high quality business generating great cash flows and that are able to meet all of its needs. So then the question is, what's this worth? What is this great quality business worth? So you go back and you say, okay, what's the free cash flow based on the definition we talked about before? So you go back, and again, this is just a simplified approach to what we do, but in essence, it's the same framework. So we go back and instead of projecting out, in this case, we take the 5-year average, which I think is a good way of doing things to start. It's conservative. And you look back and you say, okay, it's got $5.8 billion in free cash flow. You divide it by the number of shares outstanding, you get $1.27 in free cash. You take the discount rate. We use a discount rate of 10%. I know you guys are learning about weighted average cost of capital. We simply take the long interest, and it's consistent. We don't change it. And I know this is contrary to academic theory and what many believe. We take the long-term corporate bond rate, and again, we don't move that long-term corporate bond rate. There's an argument that the lower interest rates go, that the higher, that you should use that low interest rate. We don't agree with that. We take the long-term average corporate bond rate, or AAA corporate bond rate, which is about 6% as our risk-free rate, and then we add 4% equity premium. Very simple approach, but very effective. It gives us a 10% discount rate that we use. And then we use a 5% growth rate for Coca-Cola, GDP plus a little bit over the long term, to give us an intrinsic value of about $25. Then you add approximately $4 in investments per share, and then the value is about $29. It says $29.36. Believe me, Coca-Cola is not worth $29.36. It's an estimate. And again, these are all the exercise in calculating intrinsic value is an estimate. It's not a science. It's never exactly the number you get. It gives you a ballpark figure. And so in this case, we can say Coca-Cola is worth about $30 per share. And by our standards, when we look to buy something, we want to buy Coca-Cola at $15 to $17. If you can buy Coca-Cola at that price, in our opinion, you're going to get a 20% compound annual rate of return over a 5-year holding period. The problem is that it's rare that you will ever get Coca-Cola or a similar type of business at that price. So then you got to say, well, what am I going to do? Do I invest in it because I need to be invested, or do I do nothing and wait until I get the right opportunity? We've said that we're going to wait. That's our approach. It's worked for us and for our clients. We just don't think it makes a lot of sense to invest in securities that are trading at or above their intrinsic value to earn when you want to earn a superior rate of return with a lot less risk. But this is just an example of a high-quality company in the framework that we look at. And I think it's a great example because it's simple to understand, and it's easy to calculate a rough intrinsic value. The price of Coca-Cola today is about $30. So it's very, very difficult to get these high-quality companies at a substantial discount to what they're worth. One of the issues, or one of the last part of the investment process is selling. And so either because it's at the very end or because it's just not as sexy, people don't talk about the sell discipline. We think it's extremely important to have a sell discipline as embedded in the investment philosophy. And when we make an investment decision, we know the price that we're going to get out at. So for example, if we were to buy Coca-Cola at $15 today, our target price would be $30. And of course we monitor it and we change intrinsic value as it goes along. But in essence, intrinsic value doesn't grow all that much over a period of time, unless there's some substantial acquisition or capital structure activity. But for most companies, intrinsic value grows at a relatively low rate. So when we buy something, we have the purchase price in mind. And again, it's a process issue, it's an issue of discipline, and we find that when you have it, it meets the target and you sell it, and it's almost automatic. And we do that because, for one, it locks in profits and it reduces risk. And so when an investment hits our objective or our price, we've met our objective. We're done. Off we go. We wait for the next one. Part of why we're willing to do that or are able to do that is because our clients give us the mandate to hold cash. But more importantly, you lock in the return, and at the same time, you reduce risk. And you reduce risk because now you've eliminated a security trading at intrinsic value from your portfolio, and you then take the profits and reinvest them in something that's trading at below intrinsic value. The other reason we sell, if there's a change in the fundamentals. So if there's a significant change, in essence, if we've made a mistake in assessing the competitive environment, if the management comes in and changes the strategic direction in the company that we're not comfortable with, if they make expensive acquisitions, if they change their accounting policies to ones that are very aggressive and not conservative, and then if there's a negative change in the capital structure, and typically that means adding a whole bunch in debt, usually in conjunction with an acquisition. So we will sell if there's a fundamental change. Fortunately for us, most of the sells have been because they've reached their intrinsic value, and we will take our profits. And a friend of mine said, I like to pay taxes because I know I made a profit. So we're not tax driven in our investment philosophy, and so we will sell when it hits our intrinsic value. Notice this. So here's an example of what we think is a potential investment opportunity here. Now, don't go out and run and buy it, because this is one stock in a portfolio, and we're portfolio managers. So invariably the stock that we talk about is the one that's not going to do well. So don't go out and buy it. Whether it's you're listening to me or you're listening to some other investor, don't just buy the one stock they're talking about, because we all have an investment process, and each investment is part of a portfolio. And even Warren Buffett has made mistakes in the past. And if you were to pick Warren Buffett's mistake, you'd lose your money. So I can't emphasize that enough. This is just an example, and it's for illustrative purposes. It's just to have a discussion. So today, we think Encana could present some potential value. And in essence, the price of gas has gone from $6, $7 to a low of $2 last April. And so when we see that, we think there's potential opportunity. Now, there's some investors who won't touch commodity companies. We will. We're not afraid to invest in commodity companies under certain circumstances. And so we invest in commodity business that have these characteristics. One, they have to have a real asset base. It has to be identifiable. So we will never invest in a commodity company that has a potential play somewhere in northern Alberta, or has a potential mine in Manitoba. We want real assets that have been operating for a long time. We will not invest in any speculative type of exploration companies. The company should be a low-cost producer and operator. So we want companies that have at least in the top half of the cost structure. Simply because when we're investing in commodities, we're investing in them when they're out of favor, and we don't know when the commodity will turn around again. And so in that environment, you want a low-cost operator because you want the company to survive. You want the company to be able to withstand the low commodity price environment for 3, 4, 5 years if need be. So a low-cost operator is critical. We want a very good balance sheet, again, for the very same reason. A company that has a strong balance sheet can survive a long time in a low commodity environment, because they're not worried about whether the bank is going to call their loans. And you know what they say about bankers? They'll give you an umbrella when it's sunny outside and take it away when it's raining. So we're very, very wary of commodity companies that have a lot of debt for that very reason. You want good management. Again, you want to have people you trust in an environment where they're not going to panic. When we create our net asset value on a commodity company, we use the long-term normalized value of the commodity itself. So typically what investors will do is, if the price of oil is trading at $100, they will take the $100 price of oil put it into their models, whether it's cash flow model or whether it's a net asset value model, and they will then value the company based on that $100 price. If the price of oil were to drop to $50, those same investors who use that approach will then use $50 in their price models. We think that just leads you to buying high and selling low. What we do is we take the long-term average, and by long-term, we'll take a 10 or even a 20, 30, 40-year history of the price, the long-term price of the commodity, adjusted for inflation, and use that in our valuations. So when we invest in commodity companies, we use a net asset value and approach, and so we will take that long-term commodity price, normalized price, the average price over that long-term time frame, stick it into our valuation model, and then come up with a value for the company at that price. And we found that that approach leads you to do the exact opposite. It leads you to buy when the commodity is low and when the company's out of favor, and sell it when the commodity price is back to normal or high, and when the company's out of favor and when the company's in favor. So that's how we do it, and we're comfortable doing it that way. We've done it for a long time. But again, it's based on this whole notion of a long-term time frame, investing in a good company with a good balance sheet when others are selling and you're buying. So if you look at Encana itself, it meets all the criteria we just talked about. So it has a very, very strong resource base, and the resource base has been estimated to be at over 50 years. They've done some joint venture deals with foreign companies that validate the value of that asset base. It's in the top half of low-cost producer, and it's moving towards the first quartile. Again, a low-cost operator. It's got a relatively strong balance sheet. The management's realizing value and increasing the strength of the balance sheet through asset sales and joint ventures. And then when we do that calculation, when we estimate the value of Encana, we use a price of $3.75 for gas. And the price, as I said, got as low as $2. It got as high as $8 at one point in, I think, 2008. More recently, it got as high as $5. So what we've done is we've taken the long-term average price of gas, adjusted for inflation, and that long-term average comes out to $3.75. So we plug in the $3.75 in our calculations for net asset value, and when we do that, that gives you a net asset value of $32 to $36, roughly. And so we were buying it at about 18. Again, it fits the time frame, it fits the philosophy and the structure of what we do. Good quality company, safe, buying when others are selling, and a substantial discount to intrinsic value. It's got that margin of safety that we talk about, and if held for a long-term time frame, you can earn a substantial rate of return. So just to talk about what are some impediments to value investing. Why can some people do this and most others can't? And that's what really creates the opportunities. It's these impediments create these market inefficiencies that allow value investors to capitalize on these discrepancies and earn substantial rates of return with less risk over time. So the first one is just temperament. Most people don't have the temperament to go against the crowd. It's human nature to do what everybody else is doing. It's human nature to get caught up in the excitement of most events, whether it be the excitement at a football game or the excitement of an internet bubble. It's just human nature. Most people don't have the temperament or the time to go against that. The very short-term time frame, that again makes long-term value investing difficult. Most people don't have that time frame. Over-diversification makes earning substantial rates of return on a portfolio basis difficult because you just have too many securities. And then it's difficult to implement often difficult to implement an investment-based or value investing based strategy because your business interests sometimes are at odds with your fiduciary duty, and being a value investor means that you're playing a lot of things or you're investing in a lot of things that are out of favor and may not be popular with your client base. So just to summarize, value investing has been proven that it will outperform over the long term. We focus, and all value investors focus, on the preservation of capital and in investing with a margin of safety. Value investing is all about purchasing businesses. When you buy a share, you're purchasing a fractional business, and you should be buying that, a fractional interest in a business, and you should be buying that at a substantial discount to its intrinsic value. I can't emphasize enough how important security analysis is, and the whole process of valuation is to being a successful investor, and more importantly, to being a successful value investor. And then there's a whole bunch of factors that are non-economic in nature that I just talked about that make value investing difficult to implement. But that's where the opportunity lies. If you can overcome, either through personality and temperament, those obstacles, and then overcome through an investment structure and philosophy and time frame, you can capitalize and earn substantial rates of return with less risk for you and your clients. Thank you. I don't know if I've gone over time, but thank you for your attention.
We have some time for a few questions. Hey, Vito, thanks for coming. I'm really curious, why do you hold so much cash? I know you said your clients don't mind, but you had such consistent equity returns. Why don't you just buy higher stakes in the companies that you already have conviction on? I'm not suggesting that you grow the firm and buy more companies.
That's a great question. It's one we often get. We found that an investment in 20 companies at maximum is that trade-off between what makes people comfortable and managing risk in a portfolio. So when you see that initial graph that I put up there that showed our equity returns, the question is, well, why don't you do that? And the answer is because if our first investment had been a mistake, we would have been at zero. And so we would have been out of business. So it's really a risk control measure. So when we first started, we had, say, 4 or 5 investments. I don't think it would have been appropriate risk control to put all of our clients' money in 4 investments. Because if one goes bad, it's very difficult to recover from a 25% portfolio loss. And more importantly, it makes the client extremely uncomfortable. And it should, because all of a sudden they've seen a 25% loss in their portfolio. And they would probably react by taking their money out, even though the other 75% would have done extremely well. They probably would have reacted in a negative way to that 25% loss in their portfolio. So we do it for those 2 reasons. One is client behavior and comfort, and the other is that we never want to be in a position where we've lost a substantial portion of the portfolio where you can't recover.
Now, is that 70%, is it more or less fixed, or is it kind of flexible?
No. The 70% cash that we had was a residual of the process, and that's important to understand. We're not making market calls. We would love to be fully invested. But because we're so strict on the criteria for both quality and price, if we can't find equities that meet our criteria, we simply do nothing. So the cash is residual of the process. And that's all it is.
Thank you.
Thank you.
Hi, Vito. First of all, thanks a lot for taking the time out of your night to come and speak with us. I think I speak on behalf of all of us. We really appreciate it.
Thank you.
You briefly mentioned that you take a conservative approach to value and growth. And I was just hoping you could maybe expand on, one, whether you differentiate between sustainable growth and non-sustainable growth, and if so, how do you go about identifying whether it's sustainable or not?
One of our objectives, and I go back to our objectives and framework, maybe a little too much, but I think it's important to get that grounding, is we're always looking to minimize risk. And so when we make our projections, we're only projecting a 3 to 5% growth in our projections. So that distinction between sustainable growth and non-sustainable growth doesn't really apply to our modeling because we're so conservative. We're very conservative because we think projecting growth is a very, very difficult exercise to do. So we get very, very nervous when we talk to people and they start talking about strategy and big vision stuff. Because if you look back, if you take a look at any company, if you take a 10-year, if you do a 10-year review of the company, not just the numbers, but if you read the annual reports and the management statements and letters to shareholders, what you'll find is two things. One is you'll find that there's a change in management about once every 3 or 4 years. So that's the first thing. So you're always changing, quote unquote, the management who implements the strategy. And then secondly, the strategy changes almost year to year. So we're very, very skeptical of strategic thinking. We're skeptical of big strategic plans because one, they change all the time. Two, they're very, very difficult to predict in any industry. And three, they're not typically implemented properly. So that's been our experience. So we eliminate that whole discussion of growth by using a 3 to 5% growth. The advantage of that is that if you get excess growth, if you get growth beyond 3 to 5%, your intrinsic value has been really underestimated, and you get a real great rate of return.
I have a question about operating expense and management fees. Since you mentioned your time horizon is for long term, typically 5 years. So in the first year, the portfolio goes down substantially. So in that case, how will you meet the operating expense management fees? And
Our management fees as a business?
yeah.
Well, our management fees, we charge fees as a percentage of assets under management. So if our portfolio investments, and that's probably, it's another reason to be conservative, make sure you don't lose money from a business perspective, you're preserving your income stream as well. But we charge management fees as a percentage of assets under management. And that fluctuates up and down with the value of the portfolio on a quarterly basis. And I'm sorry, your second question?
Basically, the portfolio value goes down. I mean, the annual statements, the client would be pretty much seeing a reduced portfolio, but they will still see a management fee. So, how do you kind of explain to the client that? Explain the situation to the client.
We're very fortunate. We have a great client base, and we've tried to screen out clients who don't agree with our philosophy. So that's the first, I think, important thing to understand is that your clients, your type of clients are extremely important if you want to, have an investment philosophy like we have and other, value investors have. When the returns are negative, it's part of the process, and that's what we explain. I mean, we've been fortunate. We haven't experienced that yet. We will at some point. We haven't yet. But that's just part of the process. And if clients are concerned about that, then I think we've made a mistake in the clients we've chosen, quite frankly. Because what we tell our clients is, we're in this for the long term. And if, for example, the market were to go down dramatically tomorrow for some reason, and we were to get fully invested, I can guarantee you that the next month our returns would be negative because we're not going to hit the bottom. And the returns may be negative for a year. But what we try to tell our clients is that we are investing for the long term. That's what they have to buy into when they come with us. And a short-term negative performance shouldn't be a cause for concern because remember, we're buying real businesses with true, very strong fundamentals at a substantial discount to its intrinsic value. And if you bought something at 5 and it went to 4 and the value is 10, there should be no real cause for concern. It's just a market mark on the value of that business at a point in time. Over the long term, you should come back quite strongly. Yes, sir.
Hi, just wondering if you can elaborate on your risk management policy, because as an investor, you face 2 risks. One is the fundamental business risk, which you had using a margin of safety as well as the analysis of the quality of the business. And the second risk is obviously the market risk, which is something that obviously you cannot control. So do you ever use derivative instruments or other measures to manage that market exposure that you have in your portfolio?
We don't. I think there's a place for hedging, which is really what you're talking about. There is a place for hedging in portfolio management. We don't because our clients give us the mandate to be in cash. So we don't need to spend money to in effect hedge. We can just do nothing. The way our client portfolios are set up, they're typically segregated accounts, and so it's difficult and expensive to have a segregated hedging and segregated portfolio. And then finally, it's just administratively difficult to implement. So hedging is valid. We just don't do it because we can get away with not doing it. But there is a time and place for it.
Hi, Vito. A question regarding investing in commodity companies. How do you gain comfort on analyzing production costs and looking at if they increase faster than the cost of the resource price if it overrun the asset value? If you look at gold, for example, or gold producers, the price of gold went from $500 to $1,500 per ounce, but the cost of production goes faster than lowering that asset value. How do you gain comfort in looking at oil companies and natural gas companies so that won't happen?
One of the key things we do is we look back in time, and we think that the best predictor of the future is past performance. And so while there are no guarantees, the companies we look at and we want to find are companies that have had a steady history of low-cost operations and controlling their costs. When in an environment like we've had recently, with commodity prices going up and with demand going up strongly, what you'll have seen is that production costs and operating expenses have gone up at a faster rate than the price of the commodity itself. So you're absolutely right. That's a great insight. You have to be careful of that. When we're investing in commodity companies, it's typically when the industry's at a low. So the price is low and commodity prices are low, and so the industry's laying off people, the industry's not drilling as much, the industry's not exploring as much. So at that time, you'll see costs come down actually. But more importantly, over the long term, what we're looking for is companies that have had a history of being the low cost or a low cost operator in their industry. And that gives you that margin of safety because you know that if the past is a predictor of the future, that they're going to be able to manage their costs and survive in a period of low commodity prices.
Hi, Vito.
Hi.
Thanks again for the presentation.
You're welcome.
My question is regarding the conviction and the long-term time frame. So, of course, you guys choose your securities very, very carefully and conservatively. But inevitably, if you do make any mistakes, how and when do you find out the mistakes? Because of the long-term time frame, right? You have to let it play out. So when do you find out, and is there any process you take to maybe find it out a bit earlier so that you can get out early?
That's a great question. And let me emphasize that the mistake is not the price decline. Okay, so if you invest in something at 5 thinking it's worth 10 and it goes to 3, but it's still worth 10, that's not a mistake. It's just a matter of time before the market recognizes it. The real mistake is in being wrong on the business or the intrinsic value. And so if we can all agree that the intrinsic value is relatively straightforward to calculate, whichever way you use, that's pretty straightforward. Typically the mistakes I've made in the past have been where the intrinsic value, where you've made a mistake on the business. And so it's the fundamentals of the business. And typically you'll see it you can see it immediately. You can see it if all of a sudden their sales start to drop off, their margins drop off, competition becomes more intense than you expected. You can see it if their cash flow starts to decline. And we do that, and we watch that on a quarterly basis. And so we're looking at the numbers on a quarterly basis, plus we're following the news. So the one mistake we've made here at Patient Capital, we invested in Nokia when the price came down. And we thought that we were getting something that was worth, $15 for $7 or $8. And clearly that was a mistake. We made the mistake because we thought that Nokia had missed a product cycle when in fact it was a technological risk that we missed. And so in that case, we knew immediately, as soon as the guy comes out and says, we're on a burning platform, we go, oh smokes, we made a mistake here. So, and we do make mistakes. So in that case, it was immediate. In other cases, we just follow the quarterly, and you can see it. And the beauty of doing that, if you've got the discipline, and if you're looking at the accounting, and you're looking at the cash flows, and you're disciplined in some of those fundamental issues I talked about, you can anticipate that before the business shows up before it shows up as a real problem in the business 2 to 3 years ago, 2 to 3 years from the point you identified it, and you get out without a loss of capital. And so, for example, we recently sold one of our investments. They purchased a company in China for about 30 times sales. And we thought, holy smokes, China's growing, but not at 30 times sales. And so we sold it. And typically what happens, just as an aside, what happens when companies make sexy acquisitions, the market actually pushes them up. And so we sell into strength. And we get lucky. We've made a mistake in assessing the management, but we get lucky because the company or the market gets excited about this short-term sexy acquisition, and we sell into the strength. But that's an example of a case where we made a mistake on assessing the management, and we were able to get out by just looking at the news and analyzing the the information well before the issue becomes a real problem.
Hi, Vito.
Hi.
I just a quick question similar on that point, but if you always take a look at historical data and try to use that to predict the future, what if you're kind of on the cusp of industry changes, like for the natural gas industry, for example? Let's just say in 2008 you bought in Canada thinking that natural gas prices will eventually recover to historical norms, but then all of a sudden the renaissance is fracking and you have a complete change of industry. So how do you sort of think about that when you invest?
That's a great question. We tried, on a broad base, we try to minimize industry change and competitive change by buying into businesses that aren't subject to that type of change. So we won't invest in, high technology companies where there's substantial risk of product obsolescence. We won't invest in one product type companies. We won't invest in, biotech type stuff. Where there's a substantial risk of industry change or competitive change, we stay away from. In the Encana example, there is a risk that the future may not be the same. What we found again over time and through experience is that if you buy the investment at a substantial discount to its intrinsic value, and you use the approach we use, in this case natural gas, we find that the market typically more than discounts that risk and overreacts to that potential risk. And so over a long period of time, we found with all commodities, whatever the commodity was, that fear is overextended. And for every negative, there's always a positive on the other side. So you talk about the supply of natural gas out there because of fracking, which is absolutely true. On the other side is that because natural gas has all the benefits or all the substantial advantages over both oil and coal, it's far cheaper, it's far more environmentally friendly, it's easier to transport, all those things. That creates demand on the other side. And we found that over time that those negatives are offset by the positives to come at this equilibrium price that we've kind of calculated on a very low, on a very long-term normalized, basis. And I remember, in 1999, when on the cover of The Economist, I believe it was, it said, oil prices were at 10 and they were going to 5. And, they turned around. There's some invisible hand out there that we believe, in commodities in particular, that there's a reversion to the mean. Just as an aside, one of Canada's, I think, best investors, I don't know if you're familiar with him, George, is John DiTomaso, who runs the DiTomaso Commodity Fund. And he's made stellar returns using this approach in a commodity-based fund. He takes the normalized price of a commodity, and going back to your question, he uses actually options to invest in commodities. But the fundamental premise of investing in the commodities is this long-term normalized price, and he buys it essentially when the commodity is below the long-term normalized price and sells it when it gets to its normalized price, if you will. And he's got outstanding returns. But typically, it's the whole notion of reversion to the mean, and we found that reduces the risk. Hi.
I'm curious about your take on insider ownership. Obviously,
On which?
Insider ownership. So is there a percentage that you like to see as a minimum? And obviously, it has to be a management you've assessed as quality management or it's all that. But is there a minimum, and then is there a maximum at which it just becomes an overhang and something that gets in the way?
The answer to that is the more the better. We like to see management have some ownership in the business. If it's a large company you're investing in, if it's $1 billion company, unless it's, there's a founder or something, but typically large public companies, the managements don't have a substantial ownership position. So in that case, that's not relevant to us. If it's a smaller company, the more the better. There can never be too much insider ownership, other than it makes it very difficult to purchase. So we tend not to be too concerned about insider ownership, but obviously like to see it if it exists, particularly in smaller and medium-sized companies.
Okay, last question.
Thank you. This is the last question, but I've got two, so I'm going to take them both in here. The first one was, as you earlier articulated when you answered this gentleman's question, when you first started, you were primarily in cash, and that was because you didn't want to have one equity that was too significant of a position in your holdings. So my question is, what threshold do you have? How much can you allocate towards one particular security? How many, and what kind of rules do you have in place with regards to portfolio management and rebalancing? The second question, and it's a little bit of a tangential question, is what kind of efforts do you put into considering a potential catalyst for market revaluation? Do you say the market is just insane and this is the actual intrinsic, this is where they priced it, and eventually get right? Or do you try and predict why it's undervalued and why it'll come back?
We, to your first question, our rightly or wrongly, we've said 5% at cost is what we do. That's our risk control. If the portfolio grows and it falls below 5% at cost, then we'll add to that 5% to bring it back up to 5% at cost. And again, we found that that's what makes our clients comfortable, that's what makes us comfortable. 5% is enough to give you a great rate of return per investment without blowing up the entire portfolio if you're wrong that one time. And it gives you a little bit of a leeway, that 5%, in saying, you know what, this is not a 20% return on capital business. This is a 12% return on capital business. But because we're only buying 5% of the portfolio, we're okay with that. If we had only 5 stocks, then you could only ever buy the Coca-Colas of the world at that price, which would make it very difficult to ever make an investment decision. And then secondly, we don't invest hoping for a takeover or for some catalyst. We don't invest. What we found over time is that if you buy a good quality business at a substantial discount to what it's worth, and again, I keep on going back to this whole notion of a long-term time frame, because that's the mentality you have to go in. You can't hope it happens overnight. Over a long-term time frame, the market, in one shape or another, will recognize the value of that business. Either somebody comes along and takes it over, either somebody replaces the management and keeps it as a public company, or the business. And usually this is what we hope for, that the business itself returns to what we expected, and then the market recognizes the normal value of that business, and that's how we realize value.
Vito, what is the most important thing you learned in life in investing over the last 30 years?
Patience.